Hi, my name is Benjamin Stahl, and you're watching Leeb's MarketForecast.com for Thursday, September 6, 2012. Today's stock market rally above the highs of 2008 for the S&P was a virtual stamp of approval for the actions by the European Central Bank, which after months of signals, possibilities, and rumors has finally revealed a detailed plan on how they're going to combat the three-year debt crisis in Europe. German leaders have been vehemently opposed to the ECB bailout of weaker European countries. With a mandate of only trying to keep stable prices, it was a huge risk whether the ECB was ever going to ask. But pressure has been mounting, with the entire Eurozone economy stalling and borrowing costs for Spain and Italy reaching on crisis level. The ECB really didn't have a choice. Seeking to back up his previous claim that Draghi, the president of the ECB, would do whatever it would take to preserve the euro, they came out with a good stimulus plan in order to lower the borrowing costs for Spain, Italy, and other distressed countries in the eurozone. The central bank stated that they would buy unlimited funds of short-term government bonds in order to reduce the cost. By pledging unlimited funds, the ECB has demonstrated its strong commitment to lowering yields and soothing investors' fears that the euro would potentially break up. While the ECB's action is certainly an unprecedented move for them, there are several significant constraints that show this was done with an eye towards appeasing Germany. First, the bond buying program is contingent on a distressed country formally requesting aid, and then must meet strict guidelines set up by the Eurozone and the IMF. To this date, Italy, nor Spain, nor any other country has actually requested aid, but the mechanism now exists for if they needed it, to get it to lower their costs. Secondly, all ECB purchases will be fully sterilized, meaning that any money that goes out to these countries will be brought in through other purchases in the euro. This contrasts to what the Fed does during quantitative easing, where they increase the money supply. This is less likely to lead to higher inflation, which Germany is always fearful of, but might also limit the effects of the monetary stimulus package. That's all for today, and tune back for next week for Leeb's Market Forecast. Bye.